Okay, this is about finding high probability trade setups. Now, what gives you a heads up that a wild card's coming, a six aces is coming, a royal flush? Well, it's the technical information that is already available in the charts. This is what the big boys are using to make their decisions, or at least part of it anyway. Now, the big boys don't have high wild cards. The big boys don't have six aces. So what did they use? They used the historical information that's already in the charts. And the better you get at finding these, the quicker you're going to be able to capitalize on wild cards and six aces, and the more confidence you're going to have in trading those. So what gives you a heads up? The big boys. They're going to show you their roadmap, and the key to that is ahead of time. So here's some things that they look for. Patterns, obviously, previous support and resistance, armpits, fibs or HSIs, especially the S3R3 and the S5R5 area of the HSI, congestion areas, ranges, and even numbers. So what we're going to do is take a look at each one of these separately. Now, these historical clues are what tell the big boys to react. So first of all, what's an armpit? Okay, well I've shown you a picture of an armpit on a human being. Now an armpit in a chart is very similar. Okay, you've got one little support wick sticking down here, and here's the big old arm. Okay, well that armpit is something that the market will come back to. Here's one upside down. You see I've got the armpit upside down here on the man, and this little wick that's sticking up right here. After this, here's the arm sticking up. That gives you an armpit that the market will respect. So all of the pictures that you're about to look at happened last week when we took this, when I did this workshop. this tutorial. So you're going to see the exact same picture, and you're going to see all the things that the big boys were looking in the same screen. Alright, so the first armpit occurs right over here. And you see that armpit right there in the left, that was a down armpit, tells the big boys when they get back up to the area where the armpit was to sell. And of course they sell right off it. And you can see there's a big old wild card right there. Now I'm on a 240-minute chart, so remember I'm trying to show you the big picture here, and down on a 10-minute chart you can bet you would have had 10, multiples of wild cards on that trade down there. Okay? So that armpit, which was the last support before all the candles turn left, that gives you the arm below it, below it. So the last support in this little up move, and then all the candles are below that support. When the market moves back up to that same area where the armpit was, it tells them to turn again. That's exactly what it means, okay? Here's one down here. Now this is the upside down man, okay? So this armpit, that's the last resistance before all the candles became support, told the bankers or the big boys to turn here at these two areas right here, okay? Here's another one up in this corner right here. See how the market comes right back up to him, taps it, and then goes? And there's another little one right here in this little one. And that again tells the market this is the place to turn down. Now, it's after this that we get wild cards and six aces, but you can see these way before the market moves. All right, previous support and resistance, okay? So here's a support I've drawn right here in the middle of the screen, very easy to see. Now, support, when you get below it, becomes resistance, and you can see that these three places, those two places, the market stopped and that was resistance, and down she went again. Okay. Now once it's resistance, it will become support as soon as we get above it. So you see we came above that previous support, and now it comes back down. Previous resistance, it was resistance off these two pieces back here, and now it becomes support again, and up we go. Okay. Here's a support here. Support in the future will become resistance, and sure enough, that's where they're turning right there, right now. And it's after this that we get wild cards and six aces. So they're easy to spot. All right, let's just take a look at the HSI. Now, the HSI has Fibonacci's and previous support and resistance already built into it. So here we are in a downtrend, and you can see how the market is using these lines. Up to them, down to them, back to them, down to them, up to them, down to them. See? Now, remember that HSIs become support or resistance if they are respected. So not only are they previous support and resistance, but they are also, if the market respects them, then they become whatever they were, resistance or support. And you see this last resistance right here in the middle I'm showing you, right there, that became support right there. So HSIs become support and resistance also. We know that when they come down to this, we'll get a big bounce off of that, and then we'll get wild cards and 6 aces, depending on whether you're in the desert or out of the desert. Okay, here's an HSI going up. I've drawn the HSI targets up, and you can see how the market knows exactly where they are. And as they approach the SSI, they bounce off it. As they approach this one that they've already hit, which is now resistance again, up they go. All right. So once again, HSIs become support or resistance if they are respected. So, look at the turn right there at the R7. We can anticipate the turn there. That's a big move. All the way to the R7, we can anticipate them turning, and we can get ready for our wild card or 6 aces back down. Once again, these HSIs become support or resistance depending on which way you're going. So you can see that. Now, congestion areas. Congestion areas are areas where the market has stalled out, and you can see this first area that it stalled out told them to stall out at the second area, it told them to stall out at the third area, and told them to stall out at the fourth area. Now, in these cases, especially in the last two, if you're in the buy, as you approach a previous congested area, move your stop. Because the bankers are going to have a hard time going up through here. Why? Because they look to the left and say, hey, we always stopped here before. Let's stop now. And they stop. That's just how it works. All right? Got another set of them right here. Notice that when they got this first set was created, then when they came back again, they did exactly the same thing. See, bankers don't like to do, or the big boys don't like to do something they haven't already done. They like to do what they've already done because they know everybody else knows what it is. And they'll all trade in concert because of that. Here's another area, okay? You can see, as we get in that area, it stalls out. As we approach that area, it stalls out. Of course, this is even coupled with the fact that we have HSIs and support and resistance and all that kind of stuff already on here, okay? Now, ranges. When you spot ranges, and they're fairly easy to see, draw them on your chart so you can see them. You can see that when the bankers hit the bottom of the range, they turned and went up. You could anticipate a buy wild card there. When they approach the top, if you got in the buy, you need to move your stop, okay? And then when they hit the top and turn, down they go. Where are they going? Where they stopped before. Well, where was that? Same place down here. And then they go up, make an effort up, and another move down, and right back up. You see, they're moving to specific spots in the market. What tells them to stop here? What did they do before they stopped here? That's the key. All right. How about patterns? There's a bear flag. Bear flags are very powerful because we'll get wild cards after them. Okay? Here's a bull flag. Okay? And we're going to get a wild card right after it. Here's another bull flag. Notice we get wild cards. See? These patterns are very powerful to us because it tells the big boys what to do next. Right? Now, for us, it just tells us what's coming. A wild card or a 6 aces, depending on whether you're in the desert or out of the desert. All right, here's another pattern, okay? This is called a descending wedge. Descending wedges always break out south. Always is a relative figure, okay, a term. It means that, statistically speaking, that's what it does. It goes south, all right? Here's an ascending wedge, just the opposite. Okay, statistically speaking, it always breaks out north. So we know that ahead of time. And we'll get wild cards on the breaks of those wedges. This is a head and shoulders or a crown, whichever market you're used to. Okay, that is a reversal pattern. Okay, you can see that. Now, what's important is where's the neckline? The neckline is this little one that I've drawn here. Notice that on the break of the neckline, boom, we get wild cards. Just that simple. The wild card has nothing to do with this pattern. This pattern is telling the bankers what to do next. And if this crown or head and shoulders is forming, they know they're a seller. And so they begin to sell. And as soon as enough of them sell, we get momentum, and boom, we get wild cards. Okay, now, when the HSI takes off at the R3 or the S3, if you're going down, you have a probable retracement or a pullback. Okay? At the R5, you have a probable reversal or pullback. Remember, the key here is reversal versus just a retracement. Typically at the R5, you'll get a reversal, but there's no guarantee. But the R3 and the R5, or if you're going down, the S3 and the S5, are critical HSI areas for us, and you should anticipate reversals, retracements, or pullbacks in those areas. Now, even numbers. What I've done on this chart is I just simply went out and drew the even numbers, okay? You know, down across here. All these yellow lines represent an even number. You know, 161.01, 160.01, 159.899. I'm off one pip or two, but, you know, you can see that. All right? Now, every single one of these blue arrows is a reaction to that even number. And you can see that, you know, they are reacting. Look at how many reactions you have on these even numbers. Tons of them. And depending on if you're going up to an even number, you can expect the reversal back down. When you're coming down to this even number, you can expect the reversal back up. Over and over again. None of that has to do with wildcards, but each one of those tells you they're more than likely going to respect that even number, and they're going to reverse or return or whatever. And that gives you an opportunity to know that a wild card or a six aces is coming. Now, all of that's history. Not a bit of that had to do with wild cards or six aces. It's because of that stuff in the market that we get wild cards and six aces, okay? So they're easily found. Yeah, you'll have to spend some time, you know, looking at them and learning how to do them, but you don't need a 200 IQ to do this. You don't need to be a rocket scientist, and you first and foremost don't need to be the greatest trader on the planet. Anybody can see what I just showed you. How do you teach yourself to do it? You go do 200 or 300 a piece of each one of them. 200 or 300. Now it says, oh, it's a lot of work. Well, this is a business, and you know, in every business you have to work. In fact, if traders would spend more time doing the work behind the scenes, they would become better traders. But what they want to do is trade live. I want to trade live because I love all the excitement and all that kind of stuff. All right? Well, as long as you like the excitement and all that kind of stuff, it's going to be difficult to become a trader. But the more you spend in the past studying this kind of stuff, the better trader you'll become. So make sure you take a look at this disclaimer, and we encourage you to enjoy our tutorials. Make sure you're in the live calls every Tuesday and Thursday night, and bi-weekly in the Advanced ProAct Traders course. Thanks. Have a great day.